Hello there.
What would Warren do? Any aspiring investors should be asking themselves what the Oracle of Omaha, the legend himself, Warren Buffett, would do on any given occasion. And if you're watching this video, I'm sure you know who Warren Buffett is, and I'm sure you've watched at least 100 videos of his. And if you don't know his partner in crime, Charlie Munger, I would definitely recommend you do a bit of research into him and find out and read everything he has to say. He's brilliant and hilarious. And in fact, in the description of this video, I'm going to provide a link to 5 minutes of Charlie Munger roasting absolutely everyone. It's a link posted by a gentleman called the Swedish Investor, who's got some interesting YouTubes about investing as well, and I would highly recommend it. So what's the point? Well, if you know those two gentlemen, you'll know their company, Berkshire Hathaway. And whilst it might not be the most exciting company in terms of growth, it's made them both billionaires, and it's certainly one that I would trust my money to for slow, steady accumulation over time. It's definitely a safe place and a fantastic company. But the theme for this week is it the best, or is there a different one in the same vein that we could invest in? Do we trust in Warren, or shall we look elsewhere? Join me this week to have a look at and see if there's anything out there that can compete. As always, we're going to reveal who won last week's battle. We're going to check in on our portfolios, and we're going to pit two more stocks against each other. Without further delay, let's get underway. Last week, AMD and Best Buy fought it out in the battle for the best CEOs. And the winner, with 2 votes to 1, was AMD. Let's just hope Nvidia's nice to us in 2025 and gives other people a chance. A quick reminder about how the game works. It's £25 into each of 3 portfolios. That'll go up to £26 when we get to 1,000 subscribers, and we'll carry on going up after that. The first account is the Battle Royale, where you tell me which stocks to invest in. The second is the benchmark, where we compare how the Battle Royale's done to the market. And finally is the income generator, which is going to generate some dividend income, and we're going to pay that out to all of our wonderful viewers. So here's how our portfolios have done over the last 7 days. Last week, a bit of a mixed bag with a bad performance by the Battle Royale, but this week everything's in the green, which is lovely to see, and the income generator, which was lagging badly behind, up the most, 3.5%. Here were the biggest movers in our portfolio over the last 7 days. Tesla doing another big jump of 8%, not too sure what that's about, to be honest. And what's lovely to see is all the movement, or the big movement, was in green, and although they're 3 in the red, they weren't too bad. The worst performing in the green, Spotify, was up 5.7, and compare that to the worst performing in the red, Black Rifle Coffee, that was only down 3.2%. So I like that balance, and since Black Rifle Coffee went up so much the week before, I think around 10%, that is not a concern whatsoever. Here's a slightly more in-depth look at the whole portfolio over the last 7 days. Nice little climb in the green. Portfolio Snowflake, we're still a growth portfolio with a solid track record, and looking at our total value over time, unsurprisingly, Tesla at the top with a total return of 96%. On the beach, nickels, a lot of green, although I did count these out for you, and 9 are in the green, whereas 10 are in the red. So we're actually, our picks have been poor on the whole, although only by 51%, and our big green victories have been pulling us up, and so we're in the green overall. Massive Tesla, 68% on the beach, 22, that's still huge. Scroll down and compare that to our big losers. Obviously, a B&M, massive loser, the UK retail sector not doing well. But aside from that, 13%, obviously not great, but again, not as a big number as our big winners. Black Rifle Coffee is sitting in the middle. Dix, that was the new one from last week, that was down marginally, 0.6%. For all time, so that's all right. Reddit, I think that was 2 weeks ago, that's almost down 5% already, so not a great start from them, but overall happy, although I want to get more of our picks into the green. We also do have to give them time to breathe though. Okay, enough of that growth nonsense. How much are we getting paid? Turning to the income generator, the dividends that it's paying out is now up to £14.27 per year, and that's last week that was £13.53. It's just lovely to see that make a meaningful difference every week. The December amount has already been paid, so that's locked in, although it says 2.8. Now it's actually locked in at £2.43. That's paid in cash. That's sitting in our account, so we're going to add that up to March's payments of £2.55, up from £2.41 last week. And so the total we're now going to pay out our lucky subscriber in March is £4.98, up from £4.84 last week. And finally, how's it looking overall? Well, we've now added £470 into each of our portfolios. Last week, you can see there was a lovely amounts of green and some slow growth. And this week, we've continued to add to that. The benchmark still not doing as well as the Battle Royale, so we're ahead of our investing targets. Well done, us. The income generator, nice to see, up 4% overall. After last week, it was lagging so badly. It's lovely to see that. And 11% for the Battle Royale. I'll take that, considering that the market is generally estimated at an average of 10% per year. We will definitely take 11.25. Let's see if we can keep it up. I'd also just like to remind everyone that I do time split this video up. So if you only want to check out how the portfolios have done, or you only want to see the stock battle, or you want to skip any little bits and pieces of it, please feel free to just skip along in the bottom and ignore that part that you don't like. Also let me know in the comments, and I can try and tailor these videos a little bit better to suit everyone.
3, 2, 1, fight.
Okay, with that out the way, let's see if anybody can compete with the best. Are there any competitors to Berkshire Hathaway? Here it is, Berkshire Hathaway. For those who don't know about it, it's actually quite a difficult company to describe. Basically, Warren has used it to invest in a lot of companies and has bought some outright. Predominantly, amongst other things, I should say rather, is insurance. That's quite a big section of its portfolio, but he also invests in things like sweets and chocolates, or rather companies that create those and invest in those, and of course rail and freight, utilities, banks, and just a myriad different things that he has seen over the years. This is their website. This pretty much sums it up. They are old school. For those who haven't seen it, I'd recommend going on and you can have a look at Warren Buffett's letters to his Berkshire shareholders. They've become a bit of a cult classic over the years, and there is many a pearl of wisdom in there. So that's Berkshire, essentially, poorly explained, but please feel free to do a bit more research if you want to know more about it. A company that invests in other companies, what's a competitor to that? I did a little bit of research and I was suggested a few other companies. I've narrowed them down to a couple. I considered you'll see MetLife. I'm about to show you and take you through them, but I also looked at KKR, which is a little bit closer to an investment company, but I've written them out for reasons we can discuss at another time. I also looked at Sun Life and AIG. So MetLife is probably the closest to Berkshire in that it is also a financial services company, also providing insurance, but unlike a couple of the other ones on this list, they also have an asset management branch, and that's probably the closest to Berkshire of all of them in our list. Their website is a very typical, more modern one where it doesn't tell you a huge amount. You'll see all the insurance bits, but when you look at the About Us, you get all their values, what they believe in, how they're going to build flexible protection for life's changes and shifting priorities. We just want to know what the company does. And the other one we're going to look at is AIG, which is also apparently one of their competitors. And if I bring up their Simply Wall Street background, you'll see again it offers insurance and more insurance and a little bit more insurance. So I think this has less on the company management side, but as a big insurance conglomerate, and just being so invested in the various different types of insurance. I think it just about counts. When I was researching it, it was one of the few companies that were suggested to compete with Berkshire. So it's going to slip on our list, and you can let me know if you agree with that or not. And so let's take a look. Let's compare them. As I say, I also had KKR and MetLife on, but their position, according to Simply Wall Street, didn't look too great. So we've narrowed it down to AIG and MetLife. They've both got very nice snowflakes. AIG in particular is this gorgeous green one. But it's kind of doesn't go too far in each of the directions, whereas this is MetLife rather, it points a little bit harder in a couple of directions. Both very similar in that they're trading quite a lot below Simply Wall Street's estimate of their fair value, 50 for AIG and a whopping 54% for MetLife. So both very tempting. Earnings grew by 138% for AIG and 51% for MetLife. So these both seem like really good options. I'm going to narrow down. I'm going to take out MetLife, even though it's apparently a slightly better value. Its snowflake isn't as convincing, but of course, what does that mean? I'm nothing, and we can't rely on what other people think. But when you start to look at the specific details, AIG becomes a lot more attractive. Earnings forecast to grow at 37 versus 14. Already mentioned the 138 of earnings to 52. It's got a nice, reliable dividend as well. Yes, beaten by MetLife's, but that's not necessarily why we're going that way. And while there were no risks for AIG, MetLife had a high level of debt, apparently. So it's going to be Berkshire versus AIG. Now, if we compare those two more directly, Simply Wall Street has quite a surprising snowflake for Berkshire. It reckons that its future is not that great, and of course it doesn't pay a dividend, which is not a bad thing. Warren's talked about this often, and they are sitting on a huge pile of cash, which, if the market does correct, they're in a fantastic position to exploit, and they are in fact already buying things. So this picture could change. I would take that with a pinch of salt. And despite that, Simply Wall Street still thinks that it's trading well below its estimate of fair value. And of course, you can see the past is quite strong. That's all we've been talking about. That is always got to be a consideration. You've got to think it's a pretty safe place to put your money. So value-wise, pretty similar. Earnings-wise, again, pretty similar, but Berkshire just amazing year on year on year. Stands the test of time, and its earnings 39%. That was last year, whereas AIG is forecast this year. But regardless, they're not worlds away. So these are quite similar companies. The one thing is that Berkshire does have a risk. That earnings are forecast to decline by an average of 41.6% per year for the next 3 years, which is a large amount. But do we believe that? And also, with that massive pile of cash that they're sitting on, this is the time for them to invest in new up-and-coming companies which might generate more growth. So take that with a pinch of salt. Also, is it an opportunity? Up for you to decide. It's actually quite close between these two. Okay, let's take a look at and compare their high-level metrics. We've got Berkshire Hathaway on the top because, of course, a legend. And if we take a look at their little stock charts, both over 3 years, we'll see exactly why Berkshire Hathaway is so well renowned and why it's been so good. Because historically and last 3 years, as I say, it's just gone up and up and up, nice and steady, and nothing breaking the earth, not flying to the moon, but just slow and steady growth. Whereas AIG was a little bit flat with a few little drops and rises. However, more recently, it's had some steady growth, flattening out again at the moment, perhaps where the value is coming from. So past performance is not indicative of future success. So let's take a look at their key stats. And Berkshire Hathaway has a market cap of $1 trillion, which is just insane and so difficult to get one's head around. However, AIG has a market cap of 46 billion, and that is just a huge amount too. PE ratio of 9.4 times for Berkshire, whereas AIG has got a 20 times PE ratio. For a US stock, that is not bad at all, but very low for Berkshire. I think that must be down to estimates for its future growth. Big things to point out, the revenue still bringing in $364 billion versus 47 for AIG. AIG does have a dividend yield of 2%, that Berkshire doesn't, and the earnings per share, this is why all the stats need to be delved into a little bit more than taking them on face value, 66,000 versus 5, but that is because Berkshire has a bit of a strange makeup where they have never done a share division, and so each share is worth a crazy amount. Thank goodness for split shares, otherwise we would not be able to invest in this company or in either company. So, very close, very good companies, very good stats. What do we think? So there you have it. Who do you think we should invest in? Have we missed anybody else? Do you have any other thoughts or comments? It's not that close for me this week. I think we should invest in... Thank you so much for watching, everybody. I hope the markets are good to you this week, and I'll see you next week. Same time, same place.
Goodbye.